Many new investors think that if something goes wrong with a rental property, the problem stays isolated to that property. But the reality is much harsher. In most cases, the lawsuit comes straight to your personal name, and that can put at risk not just the building, but your savings, your own home, and everything you've worked hard to build. The tough part is that most people don't realize it until it's too late. But once you understand how to protect yourself legally, you start seeing rental properties in a completely different way. Let me tell you Alex's story so you can see exactly why this matters so much. Alex was 29 when he bought his first duplex to rent out. He saved the 20% down payment, screened the tenants carefully, and everything looked perfect. He was clearing about €400 a month in positive cash flow after expenses. But he made one mistake almost every beginner makes. He bought the property directly in his personal name with no legal separation, and 3 years later that single decision almost cost him everything he had. Picture one big box drawn on the whiteboard. Inside that box is Alex as a person, and also all his assets, the duplex, his savings, his salary, his stock investments, even his own home. Everything is mixed together in the same legal container, with no walls separating personal stuff from rental income generators. One winter morning, a tenant slipped on the icy outdoor stairs, broke his ankle, needed surgery, was out of work for months, and hired a lawyer who filed the lawsuit directly against Alex. Because legally, Alex wasn't just the owner of a property. He was personally unlimitedly liable. And if the case had gone badly, the compensation could reach his personal savings, his future income, or even other assets that had nothing to do with the duplex. Here's the first insight that changes everything. In real estate investing, protection doesn't start with more insurance. It starts with structural separation. Insurance is important, but it only covers part of the risk, like a seatbelt that helps in a crash but doesn't stop the car from being totaled. So now we know one key thing. When everything is in your personal name, a problem in one property can threaten your entire net worth. But the good news is there's a simple way to create a legal barrier. The most common tool investors use to create that barrier is called a limited liability company, or LLC, an independent legal entity. Now imagine two boxes on the whiteboard. On top is Alex as a person, below is the LLC that owns the duplex. Draw a solid wall between the two. That wall means the LLC is the legal owner of the property, and Alex only owns shares in the LLC. When a problem happens at the property, like the tenant's fall, the lawsuit usually stays contained inside the LLC, limited to the assets of that company, which are typically just the property itself and some operating cash. Your personal savings, your home, your salary stay protected behind that wall. But here's where most people go wrong, and it's the second open loop we're going to close. Alex kept investing. He bought a fourplex and later a single-family house. At first, he put all the properties inside the same LLC because it seemed logical and kept his personal assets separate. However, that created a new risk. Imagine now one big container called Alex Rentals LLC, and inside are the duplex, the fourplex, and the single-family house. If a big lawsuit hits just one property, for example, a serious issue at the fourplex, the risk can spread to everything inside that same container, meaning one property's problem can jeopardize your entire portfolio. That's why experienced investors put each property in its own separate LLC, so a problem at the duplex doesn't touch the fourplex or the single-family house. The goal is clear: isolate risk horizontally between properties and vertically between you and the assets. So let's recap what we've covered so far. First, basic separation with one LLC per property to shield your personal wealth. Second, never mix multiple properties in a single entity to avoid cross-risk. And already this makes you think differently. You go from being a simple landlord to someone building a protected system. Now Alex worried about something many investors ask: does creating an LLC increase taxes? The answer is, it depends on how many properties you have and how you manage cash flow. For someone with one or two small properties, in Spain today, being a private individual is usually simpler and often more tax advantageous, because under personal income tax, IRPF, You can apply 50% to 90% reductions on net rental income from residential properties, depending on whether you lower rent, renovate, or are in a stressed area. But when the portfolio grows, an LLC lets you pay a flat 25% corporate tax, deduct expenses more broadly, including depreciation and operating costs, and defer taxes if you don't distribute dividends right away. The key is to consult a specialized accountant. There's no one-size-fits-all answer, but understanding this difference helps you decide smartly. Years later, Alex had several properties, and his accountant proposed the structure used by investors with medium and large portfolios. Imagine 3 vertical levels stacked. At the bottom, individual LLCs for each property. In the middle, a holding company that owns all those LLCs, and at the top, Alex as the individual. The holding company acts like an umbrella. It adds extra separation, simplifies centralized management, and in many cases optimizes future estate transfer with advantages in inheritance and gifting. This lets the portfolio grow without one part's problem affecting the whole. The toughest lesson Alex learned wasn't just legal, it was a complete mindset shift. Beginner investors think like landlords, focused only on the property and monthly cash flow. The ones who build lasting wealth think like business owners. They create structures that generate income while also protecting what they generate. Because real estate can grow your finances, but the right structure is what ensures that wealth lasts for decades and doesn't disappear because of one unexpected incident. In the end, Alex's lawsuit was resolved without destroying his wealth, but that experience taught him something simple and powerful. The smartest investors don't just buy properties, they build systems around them to generate income and protect everything they've built. If you're just starting or you already own properties, talk to a lawyer or accountant specialized in real estate investing. The right structure isn't complicated, but it completely changes how you view and protect your financial future. Thanks for watching. If this helped you, hit like and subscribe for more on how to invest intelligently in real estate.